Hi everyone, and happy holidays. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today is December 18th, 2023. In our previous December 6th Following the Money podcast, we said that our Asbury 6 risk management model had been positive the stock market or positive the S&P 500 since November the 2nd. We also said that our SEAF model, SEAF is an acronym for sector ETF asset flows, was overweight the technology sector or XLK since October the 9th. The S&P 500 has risen by 10% since November the 2nd. Meanwhile, XLK has risen by 13.4% outright while outperforming the S&P 500 or SPY by 4.4%. That was since October the 9th of that signal. The Asbury 6 still remains positive heading into this week, and the SEAF model remains long overweight technology. Today, I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. Now let's follow the money. In this new video version, I'm going to take you inside Asbury Research's Research Center to show you some of the key models and metrics we are focused on right now. So this is the landing page at asburyresearch.com. So we're moving over to the Research Center button here and logging in. And you'll see at the very top of the Research Center, we have all of our models. The Asbury 6 is here, the SEAF model is here, all of our models are here, and then as we scroll down the page, there's the individual reports, most of which are tied into our models. So it's a pretty comprehensive coverage. Let's go back up here to Asbury 6 and get ourselves in there, and let's have a look on how this looks going through the end of last week. We're still in the morning of Monday the 18th here. So through last Friday, 5 of the 6 Asbury Research constituent metrics are green or positive. It takes 4 or more of these metrics to actually give us a long signal, a bullish signal. So that occurred back on November the 2nd. Like I said, the S&P 500 is up 10% since then. You can see the only one that's negative right now is the rate of change in the S&P 500. All the other ones are all green. They're all positive. The earliest ones turned positive on October the 31st, and then we have a couple here that turned early part of November, and then our stocks, our relative performance, stocks versus high yield bonds actually turned about a week ago in December. So the point of the Asbury 6 and the reason we built the model is because it's very difficult most of the time to tell what the condition of the market is or where the market's going based on what you see in the S&P 500 every day. All the volatility, the day-to-day volatility. The S&P could be up 50 today. It could be down 50 or 60 tomorrow. Very difficult to try to weather that constant up and down price activity and not be shaken out of a pretty good idea. So this model, it keeps me initially, I just kept this in-house, and now we're sharing it with our subscribers, and it helps our subscribers to understand the difference between a model or between a market that might have a couple of bad days and where the market might be making some kind of an important shift from up to down, and you need to pay attention and you need to do something about it. So this has kept us in the market since November the 2nd. So let's back out and take a look at our next model that we're going to look at today, and that's the SEAF model. As I mentioned, SEAF is an acronym for sector ETF asset flows. We built this model, I probably built this model close to 10 years ago because the sector rotation really has sped up over the past 5 to 10 years. These sector trends where you might have outperformance by a sector, they used to last a quarter, maybe 2, and now anecdotally, it might be 6 or 7 weeks. Everything has gotten faster with more and more computerized trading, which some folks think, some experts I should say, think is about 80% of the daily volume that goes into the market. So what the SEAF does that is different is rather than waiting for the relative performance charts to tell us what to do, it's actually measuring the money that is moving around the sector space. Really, it's actually moving around the S&P 500. The 11 sectors of the S&P 500 together represent the S&P 500. They're just parts of the whole. So what we did is built a model that measures the velocity of money that is moving into sectors and moving out of sectors. And we did it in 3 different time frames. Trading, which is a week, tactical, which is a month, and strategic, which is a quarter. And then we score them. The fastest money in is going to get a low score. The fastest money in over the past trading week, you can see here, was consumer discretionary, XLY. The second fastest was technology. Where was the money coming from? It was coming from the other side of the equation. Number 10 and number 11 were materials and consumer staples. So we could say generically, what happened last week? Well, the money came out of materials and consumer staples. It went into technology and it went into consumer discretionary. And then we do the same for tactical. We do the same for strategic. And we add up those scores. Any scores that are 15 or lower, those are favored. The neutrals are from a ranking score of 16 to 24, and the avoid you can see down here between 25 and 33. This week are materials, staples, and energy. This is updated once a week on the weekend, typically midday on Saturday. And the new idea is the new rebalancing, should there be one, it's assumed to take place on the opening the following Monday. So this model has done quite well over time. It's outperformed 10 of the past 13 quarters. It's outperformed SPY, and it's done it with a little less risk than the S&P 500. If you're interested in more information about these models, go to asburyresearch.com and go to models, and you can find out more about the Asbury 6, about the CEF, and about all of our other models. So what we generally like to do is pay attention to the top 3. The top 3 are currently technology, consumer discretionary, and real estate. That's where the money is going right now, and that's where we think the opportunity is. Let's have another look at the CEF model via specialized charts that we made to go along with the CEF model. We call these charts rainbow charts for obvious reasons because of the colors up here. And what the colors show, this chart goes back one year, and it shows the rankings. Favored rankings are in green. The neutral rankings are here in the middle in yellow, and the avoid rankings are down at the bottom here in red. So what this is showing is that technology moved into a favored status according to the CEF model on October the 23rd. You can see it's jerked around a little bit in there, but it's managed to stay with a score of between 3 and 15. During that time, XLK has outperformed SPY by 4%. You can see that here. Then if we go back across the chart and go back to the early part of the year, we can see this sustained time frame here where XLK, it got into favorite territory and it stayed there. Basically between the middle of January and the middle of April. During that time, XLK outperformed SPY by 10%. And then down here you can see where the ranking dropped off here to neutral to avoid here during July and August. It was a period of weakness where XLK underperformed SPY. So that's how this works. All we're doing is we're following the money. We're not trying to figure out what the Fed's going to do or what the market's going to do after earnings or who might win the election. We're chasing the money. We want to know where the money's going, and we want to go there, and we want to avoid the places that the money's leaving. Now let's move on. Take a look at a couple of charts that, here we go. Let's look at a couple of charts that are also from our premium research. These are charts that have shown up in our research over the past few days from various reports. I think they're pretty important to paying attention to right now, considering the condition of the market. The market's overextended. One of the ways we can tell that the market's overextended is by looking at investor sentiment. This is down at the bottom, this is a daily survey of future traders' bullishness on the S&P 500. You can see during periods where it's very bullish, 82% or more, which it is right now. It's just kind of moving into this 82% area right now. The previous time that it was there was on June the 16th. About 5 weeks later was the July top at the end of July that we had here just this past summer. And then we went into a pretty sharp decline into October. You could also see that futures trader sentiment was most bullish here back in September of 21 and January of 22. Also market tops. You can see February 09, or 2020 rather, February 2020 peaked with way too bullish futures traders, and that actually triggered or helped to provide the environment, let's say, for the collapse that went down into the COVID low in March of that year. Here's September 2018. Again, another most bullish extreme by this metric. Is that a signal to tell us to do something right now? No, it is not. Why? Because the Asbury 6 is still positive. The market internals are still telling us that we can remain with this trend, whether it's overextended or not, because the internals are good. The internal part of the market is still healthy. When those flip, when the Asbury 6 turns to red amid these conditions, that's when it becomes actionable. Let's look at another metric, again, from some of our research over the past few days that will let us know when it becomes more actionable. And what we have here is the S&P 500 up top, daily since August, and the VIX, the CBOE Volatility Index, during the same period with its 21-day moving average. Why the 21-day? Because that is Asbury's tactical time frame. Our strategic time frame is 63 days. Our tactical time frame is 21 days, or a business month. You can see since October 31st, the VIX fell through the 21-day moving average, indicating investor complacency, which means the market isn't afraid. The market isn't worried that prices are too high or something's going to come and take away their profits. They're very comfortable in being long. And during this time, from October 31st, we had a really nice rally here, obviously, in the S&P 500. A couple of days later, here on November 2nd, is when the Asbury 6 turned to green. That really gave us the green light, so to speak, to be long, and we're still there now. But note where the 21-day moving average is. It's at 12.86 today, and right on top of the market. What does that mean? It means when the VIX starts trading above the 21-day moving average, which it's really close to doing, and stays there for a couple of days, the next thing you're going to see is the Asbury 6 is going to start to turn to red, and that's going to be our cue to start to take some equity exposure out of the market or have it hedged in some way so we can make sure we can capture as much as this up move as we possibly can. Next, I wanted to mention a holiday offer. Watch your email this week. We are going to, if you are on our list, if you are on our comp list, so to speak, those who have asked us for information, we send you a piece of information every couple of weeks. You get access to our podcast here. Those of you that are on our list, and if you're not on our list, then you could do so by signing up through asburyresearch.com. If you're on the list, we're going to send you a holiday offer, a discounted subscription for the premium service for 3 or a 12-month subscription. This is an introductory offer only for new subscribers. So if you've been watching us and you like our approach to markets, this is a chance to be able to get the premium service for a discounted price. Finally, I will be a featured guest on Tuesday morning, December the 19th, with the Schwab Network. Their show, the Morning Trade Live show with host Oliver Rennick. Oliver and I have been doing interviews together for a long time. So this is tomorrow, December the 19th, about 9:15 in the morning Central Time. I hope you'll join me there. So there it is, our latest bi-weekly Following the Money podcast for today, and a short synopsis of what we think are the most important things to pay attention to as we move into the new year. We'll see you again right here in about 2 weeks. It'll be after the holidays with our next Follow the Money podcast. In the meantime, you can subscribe to the Asbury Research channel on YouTube for more data-driven trading and investing information just like this. If you'd like to learn more about Asbury Research's data-driven models, please visit asburyresearch.com and click Models across the top of the screen. You can see models right here, right across the top of the screen. If you're interested in getting more information about our services for individual investors and also money managers, also visit asburyresearch.com and use the Contact tab right here so you can speak to us, tell us what type of an investor you are, and we will follow up with you and we will let you know the products and services that are available. So again, thanks for watching. Hope you have a wonderful holiday season, and we'll see you with the next episode of this probably in the first or second week of January.